No protests, no news flashes, no parliamentary debates. Just a handful of executives in tailored suits, gathering quietly in a Swiss city named Basel, deciding how much danger the global economy is allowed to bear. It sounds unbelievable, yet those discreet meetings gave birth to the most influential financial regulations on the planet. Guidelines that determine how far banks can go with lending, how much risk they can assume, and how much real capital they must hold in case everything falls apart. And here's the ironic truth: almost no one knows they exist. Welcome to the Financial Historian, where money, authority, and history intersect. And nothing is ever as straightforward as it appears. Our story begins in 1974, with a small German bank that managed to nearly crash the global financial system. Its name was Rewrote Bank, a mid-sized institution in Cologne that specialized in foreign exchange. One June afternoon, it went bankrupt, right in the middle of a currency transaction. Its American counterparties had sent millions of dollars to Germany that morning. But by the time the German side was supposed to send back the equivalent marks that afternoon, Rewrote was gone. The timing of the default, stuck between time zones, froze the entire network of global payments. It was a rude awakening. Banks around the world suddenly realized how fragile the system had become. Globalization had connected every major financial center, but the rules were still local, national regulators trying to control an international market. The panic over Rewrote's failure forced the world's central bankers to do something unprecedented: coordinate. Later that year, the central banks of the so-called G10, the world's richest economies, gathered at the Bank for International Settlements in Switzerland. The BIS was already a peculiar institution, founded after World War I to manage German reparations. It quietly evolved into a kind of central bank for central banks, neutral, discreet, and above all, private. In that secluded environment, they formed a new group, the Basel Committee on Banking Supervision. Their mission sounded simple: make sure major banks never again collapse due to mismatched rules or oversight gaps. But in reality, they were creating something much larger, the blueprint for how global finance would define safety itself. It took more than a decade, but in 1988, the committee unveiled what became known as Basel I, the first truly international banking standard. It introduced a single, simple requirement: banks had to hold at least 8% of their risk-weighted assets in capital. In plain English, if a bank lends out $100, it must keep $8 of its own money, real equity, as a safety cushion in case things go wrong. For the first time, risk had a global yardstick. No matter where you were, London, Tokyo, or New York, banks were expected to speak the same language of capital adequacy. And while Basel I wasn't technically law, it became law in practice. The biggest economies implemented it through national regulation, and smaller nations had little choice but to follow. In global finance, if you weren't playing by Basel's rules, no one wanted to play with you. But the simplicity that made Basel I powerful also made it dangerous. To assign that famous 8% requirement, regulators categorized assets by risk weight. Government debt, for instance, was given a 0% risk weight, meaning banks didn't need to hold any capital against it. Corporate loans, on the other hand, were 100% risk-weighted, requiring the full buffer. Mortgages were somewhere in between. The logic was clear: governments rarely default, while private companies can fail. But the effect was dramatic. Banks began pouring money into government bonds, not businesses. Lending to the private sector suddenly looked expensive. A rule designed to make banking safer had quietly redirected global credit toward the state. By the late 1990s, however, the world had changed again. Financial markets had exploded in size and complexity. Derivatives, securitizations, and global capital flows made Basel I look primitive. Banks argued they could measure risk better than regulators could. And in 2004, the Basel Committee agreed. Basel II arrived as the modernized system. It introduced what it called the 3 pillars of stability: 1. Minimum capital requirements; 2. Supervisory review; and 3. Market discipline. On paper, it sounded responsible. In reality, it handed the keys to the vault back to the bankers themselves. Under Basel II, large institutions could use internal risk models, their own mathematical formulas, to determine how much capital they needed. If their models showed a certain asset was safe, they could set aside less money for it and lend more. This was regulation by spreadsheet, and the incentives were obvious. The lower your calculated risk, the higher your profits. It was, as one analyst later called it, letting the fox design its own henhouse. And the foxes got creative. Banks began assigning extremely low risk weights to highly rated securities, like the famous TFL, rated mortgage bonds before 2008. According to the models, these assets were as safe as government debt. In practice, they were toxic time bombs. But the rules allowed them to be multiplied across balance sheets at breathtaking leverage. Then came the crash. The subprime crisis revealed that the entire system of risk weighting was built on sand. The mathematical models had been fed the wrong assumptions, and the safest assets turned out to be the most dangerous. Trillions evaporated, and governments had to bail out their banks. In the wreckage, regulators returned to Basel, desperate to rebuild trust in the system. By 2010, the new standard was born, Basel III. This version promised to fix everything. It tightened definitions of capital, insisting that only true equity and retained earnings counted as real buffers. It introduced new safety ratios, the leverage ratio, a backstop against excessive borrowing, and the liquidity coverage ratio, which required banks to hold enough high-quality assets to survive a 30-day market freeze. It also added the net stable funding ratio to reduce dependence on short-term money. In theory, Basel III made the system tougher. In practice, it still relied on the same fragile core, confidence in models, ratings, and political will. Even after all the reforms, many major banks continued to operate at leverage ratios that would terrify a lay person. For every $100 of assets, some still hold less than $5 in true capital, and the complexity grew. What started as a simple 8% rule had evolved into a labyrinth of cross-referenced ratios, conditional calculations, and model-driven assumptions. Regulators promised transparency, but the language of Basel became so technical that only insiders could truly follow it. The result, risk didn't disappear, it just changed shape. Basel's rules, meant to discipline banks, had become the invisible architecture of global finance. Every interest rate decision, every credit expansion, every liquidity squeeze now flowed through its logic. And yet, the world outside barely noticed. But there's one crucial question left unanswered. What happens to the countries and the banks that don't follow Basel's rules? That's where the story turns from technical to political. Because Basel may not be a law, but defying it comes at a price. Basel was never supposed to be a global constitution. It began as a coordination meeting, but within a few decades, it quietly became the rulebook that decided which banks would thrive and which ones would be left behind. The Basel Committee itself has no police force, no court, and no real legal power. Yet somehow, every major economy treats its standards as gospel. The reason is simple: reputation. In global finance, trust is everything. A bank that doesn't meet Basel standards is treated like a driver without insurance. You can share the road with it, but you'd rather not. Investors, regulators, and other banks look at compliance as a test of credibility. When a country lags behind, its banks start to pay the price. Their credit ratings fall. Borrowing becomes more expensive. International lenders shorten maturities or raise rates, afraid of hidden risks. It's the quiet way the market punishes disobedience. That's why, even though Basel is officially voluntary, almost everyone ends up adopting it. It's not law, it's leverage. If your country doesn't keep pace, your financial institutions risk isolation from the global network that clears payments and moves capital across borders. To move dollars internationally, small banks depend on relationships with giants like JP Morgan or Citi. Those giants, bound by Basel and anti-money laundering rules, can't afford to work with partners from non-equivalent jurisdictions. The result is silent exclusion. Countries that lag behind lose access to cheap credit, trade finance, and the lifeblood of modern commerce. Basel I was simple enough that nearly every nation could join in the 1990s, but Basel II and III raised the bar. They required armies of analysts, expensive data systems, and detailed internal risk models, tools many emerging markets couldn't afford, so the world divided into tiers. Wealthy economies, led by the United States, Europe, and Japan, implemented the new standards first. Others improvised, adopting partial versions or hybrid systems. Even today, some smaller nations still operate under Basel I, while the G20 transitions toward Basel IV. But what exactly is Basel IV? In truth, it's not a completely new framework. It's the final stage of Basel III, a sweeping overhaul designed to close the loopholes that nearly brought the system down again. The Basel Committee knew banks had learned to manipulate internal models to minimize their required capital. So Basel IV introduced a new concept called the output floor, a kind of regulatory safety net. It means that no matter how sophisticated a bank's model is, it can reduce its capital requirements by more than roughly 27% compared to the standardized method. In plain terms, it puts a limit on creativity or on deception, depending on your point of view. Basel IV also revises how banks measure credit, market, and operational risk. It tries to simplify what became a tangled web of calculations. But with every attempt to clarify the rules, another layer of complexity appears. The global rollout began in 2023 and is expected to stretch into the late 2020s, with Europe and the UK among the first to implement it. The United States, as always, is following on its own timeline. Japan, Canada, and Australia are close behind. Meanwhile, developing countries are again left to catch up, adapting as much as their infrastructure allows. On the surface, the Basel Accords look like technical accounting reforms, but beneath that, they are mechanisms of power. They determine who gets credit, how money circulates, and whose economies grow faster. When Basel declared government bonds risk-free, it wasn't just a financial assumption, it was an incentive. Banks responded rationally. They shifted massive portions of their portfolios into state debt, which required no capital buffer. Governments benefited immensely. Their bonds became the safest, most liquid collateral in the system, guaranteeing a constant demand for public debt. Basel effectively created a built-in buyer for governments and a structural dependence for banks. The more the rules evolved, the more this feedback loop deepened. By 2020, global banks held over $13 trillion in government bonds, much of it justified by Basel's zero-risk designation. The same logic that once aimed to protect the system from collapse had turned it into an engine for sovereign debt accumulation. The Basel world rewards the state, punishes the small business, and locks capital into instruments that feel safe but yield little. For smaller banks, the consequences are even sharper. Compliance with Basel III and IV requires vast resources, internal modeling teams, legal departments, regulatory reporting systems, and constant audits. That's easy for JP Morgan or HSBC. It's ruinous for a regional lender. Many small institutions either merged into larger ones or exited global operations altogether. Basel, meant to prevent systemic risk, quietly accelerated the concentration of power in the hands of the few, the banks deemed too big to fail. But the danger isn't just consolidation, it's uniformity. Every major bank on the planet now measures risk the same way, with the same formulas and the same benchmarks. That might sound efficient until the system faces a shock. When everyone holds the same assets and reacts to the same triggers, safety becomes correlation. One domino falls, and the rest follow. Basel made finance look safer on paper, but it also made it more synchronized, and therefore more brittle. There's an irony in how this all unfolded. Basel was created to make banking more resilient, yet it did so by standardizing fragility. It replaced judgment with models, human discretion with formulas, national policy with global consensus. It made financial regulation feel objective, like physics. But unlike physics, these rules are written by people, negotiated by committees, and influenced by lobbyists who understand every decimal point better than the public ever will. Still, the illusion works. To the outside world, Basel symbolizes prudence and order. Regulators cite capital ratios with confidence. Bankers point to compliance reports as proof of strength. The numbers look neat, the acronyms sound reassuring. CET1, LCR, NSFR. But behind those letters lies the same human pattern that drives every financial story: fear, ambition, and the eternal pursuit of leverage. And yet, without Basel, the modern system might not function at all. It's the unspoken glue that keeps trust flowing between nations, between lenders and borrowers, between investors and savers. It defines the invisible boundary between what feels safe and what feels reckless. Even those who criticize it still depend on it. So what do we really learn from Basel? That regulation can never fully control risk, it can only redirect it. Each attempt to make banking safer pushes danger somewhere else, into a new product, a new loophole, a new part of the world less regulated than the last. Basel didn't eliminate the boom-bust cycle, it simply changed its geography. In the end, Basel didn't make finance perfectly safe, it made it legible. It turned a messy, intuitive world into a grid of ratios and coefficients that look scientific but rest on trust. And trust, as history shows, is the most volatile asset of all. The next financial meltdown won't appear from the place Basel predicts. It never does. Yet, when it strikes, the same panels will gather again in Switzerland, quietly drafting fresh equations, fresh ratios, and fresh assurances of stability. The cycle repeats, refined, hidden, and essential. Basel was designed to make banking safer. Instead, it made risk invisible, and whoever defines the rules for unseen risk holds the real power. If this shifted your view, hit subscribe. History holds the clues, and I'll guide you to them.